are live now. Welcome, everybody. We are here to talk about taxes in 2025. Excited to host you here with my colleague, Daniela. You're in the right place if you want to look ahead and not just backwards. And you don't want to wait till the last minute to figure this stuff out. Obviously, we talk about business in the context of growth. We want to do the right thing, the right tax efficient thing with an eye to the future. So if you're here to grow your business, again, you're in the right place. And if you're looking to solve all your tax problems with one webinar, I'm going to let you down early and let you know that's not what we're able to do with one call. And we can talk more about how we work as we work through it. But let's talk a little bit about what we're looking at on this webinar. We'll talk a little bit about who you're listening to. As promised, we will look at the tax landscape for 2025. I think this is a year of uncertain changes. We're certain that things are going to change, but uncertain as to what, and we'll get into that. We'll talk a little bit about how we think about strategy, what you can do, what not to do, and then at the end, we will summarize the key points to talk about with your tax advisor. Hopefully that's us. And if you're not getting that strategy, we'll give you a way to connect with us at a deeper level. But first, we do want to say that the information shared today is for informational purposes only. There are exceptions to every rule. Oftentimes we're looking for those exceptions, but anything shared today could be that you are the exception. So make sure to discuss this stuff in detail with someone that knows taxes, that knows how to file, and knows what's gray versus black versus white. Well, let's get started with announcements. We have a few important deadlines coming up. First, I should share the team here. You've got myself. We've got a new face with us, Daniela, and Carla, who is with us in the chat. She's, how do we get tax managers during busy season to be participants on a webinar? Well, you have to give them the flexibility to present on their own time. So we've got a few pre-recorded clips from Carla. So she is live, but she's also busy. She was nice enough to give us her voice and attention that we are going to autoplay when it comes to her slides. And then Daniela, who you'll hear from today, who joins us as a new partner in the firm. Just big picture, you might see some new names in terms of brand. This is a consolidated firm approach. We are shared economy tax, but we're also more than that. You'll see some of our other firms. We are one firm. So we operate as one firm with different storefronts. But as you work with our firm, we bring you on as an advisory client into the Centurion family of firms. So just something to note in case you've been following us for many years on the shared economy side, the family has gotten bigger. And it doesn't mean that we have given up any of our specialties. We still are very invested in the shared economy space. For that means freelancers, it means Airbnb hosts and property managers, and it means Turo, get around, car share fleet owners. It makes a core part of our demographics of clients. And we, on our side, train our team to be able to niche down and develop playbooks within each of those niches. And the other brands, the same applies. Largely, we work with innovative, forward-thinking small businesses. We are not the firm for the ultra wealthy. We're not the firm for the uber rich, for the large company. We are the firm for the small operator who's trying to build their own wealth. And we want to be on that journey to support you, and very excited to grow that family with now another firm in Beam. If you have not seen any of our stuff, we'll just quickly share that we do work within the niches to invest in and to advocate for our clients. In the bottom right-hand corner, that's me testifying before Congress during the Tax Cuts and Jobs Act. 0% of what I recommended to Congress ended up in legislation. Maybe that could be expected, but we did take the time to meet with lawmakers to really share what's important to small businesses, to those that are looking to build their wealth by accumulating real estate, by operators who are freelancers maybe. And those I think really embody what we try to do at our firm. I do come from a bigger firm. I think the first 6 years or so of my career are now a blur. But I did get experience working with very big companies and seeing what they do to advocate for their clients with lobbying and such. There really isn't a voice for the small businesses at that level. So what we try to do is we try to build content, whether that's videos or courses, and we get on blogs. We get on podcasts with other influencers in the space so that we can bore their audiences, not bore, but start to inspire the kinds of strategic thinking that we encourage in our clients. And you can see here we've done that through publications, and then recently I think our other big announcement is we found a partner through the kind of accounting network and conference circuit, Daniela, who joins us from Beam. So we bring in another family of clients, another family of staff, and Daniela really owns the accounting side, which was really needed, I think, on our side. I think we were always tax focused, and we really needed an accounting partner. So I'm very happy to now have Daniela and Beam. I don't know, Daniela, if you just want to wave or say hello quickly.
Hey, everyone. Happy to be here and take over accounting.
We're happy to have you. So some key dates. We've got them up here. You could probably read faster than I can present it. So the punchline there is that we file on an accelerated basis, and we want to make sure that we have the information required ahead of time in order to timely file your return. So a lot of the times, you might know this, that when you file the return, it takes a few days for the IRS to confirm that it was received. Sometimes, for whatever reason, entity changes. If you get married, if you're a new client, the return will be rejected. So filing on an accelerated basis allows us to make sure that we take care of any glitches, if you will, ahead of time. And it gives you enough time to pay taxes if they're due, avoid interest and penalties. So same goes for April. And I want to say, there very well could be exceptions to that. I think we reserve those for emergencies. So we really do want to be disciplined as a firm to make sure that we're getting things done now in order to make sure that we don't run into problems at the 11th hour. So that deadline is real. We will file, and there will be emails to back up saying, hey guys, remember we need to get everything in by March 24th, Monday, March 24th, in order to file you on time. If you don't get things on time, it's okay. We will file an extension because we do have to be disciplined and be fair to the clients that are meeting that accelerated deadline. We have a whole process to file extensions. So again, if you're a new client, we definitely want to make sure we've got prior year data so that we're not asking for things at the 11th hour. So thank you for that, Carla. Thank you for joining virtually. A little bit about how we work as a firm. I have let's see here. I can just share this one more time. Really, the way that we think about our practice is there's 3 core pillars. One is compliance and controversy. So that's essentially filing your tax return. I think this is an important slide, actually, where we are taking things that happened last year and we are correctly, as best we can, presenting it so that we can file it with the federal and state authorities. And there are sometimes strategic options that you can do last minute, retirement contributions, but the toolbox is very narrow in terms of what we can do. So we really think about this as something that we want to do accurately, efficiently, and in a way that's defensible. So the controversy part has to do with getting notices. If you get letters, please share them with us. We do, for our Centurion Plan clients, work on a closer level where we will actually respond to the IRS for you. It's a very important part of compliance, especially if you go and apply for a loan later down the road. And if you filed an amendment that never got filed, it showed more income. These are the kinds of things that really start to trip up if we don't do it right. So we do take that part seriously. The second pillar, it's accounting. It's getting the numbers right. And then the third one is usually what clients want to get to, but you don't get to it unless you check the boxes in 1 and 2, which is the strategic, forward-looking, what do we do? Hey, I have cash. How do I allocate this? Do I buy a business? Do I buy an asset? Do I contribute into my retirement? Can I do a self-directed IRA? That's the stuff where you're looking forward and saying, hey, is this a tax efficient way to allocate resources, my time, my money? And oftentimes that's not just doing something for tax purposes. It's really looking at what your broader business picture is, what your broader investment picture is, and thinking, hey, are there rules right now where one category is favored the other? And that's what we do in tax planning. We really want to figure out, hey, what is the highest cash post-tax ROI? And given that, do we want to take advantage of that? And sometimes the answer is no. We think that our clients make better decisions when they have options. And that's essentially what we're doing in that strategic budget bucket. And it's why we're more than just a bookkeeping and tax filing firm. That third bucket is really where we add a lot of value, we think. So with that, let's start talking about what's changing in 2025. And before that, again, this is for our clients. If you're another accountant watching this, you're not going to get a lot of value out of it. But we really think about rules within three buckets. So the first is taxes. It's probably the most obvious. You need to report your income is basically the first point we always make. And there's challenges that become irreversible if you don't. So for example, if you do earn money on Airbnb and you don't report it, and the IRS later does a system check where they're able to pull data out from Airbnb, and now with requirements, if you earn $600, 400 is the minimum rule. But now if you earn 600, that gets reported to the IRS database via 1099-K. That information is going to trigger the IRS to send you a notice that says, hey, you earned whatever your revenue is in 2024. You didn't file any deductions on it, so we're just going to tax you on revenue. So we want to make sure that we are looking at net income, which brings us to point two, which means that you need an accounting system. You need some kind of accounting system that works from top line, which the IRS knows, down to bottom line, which only you know based on accounting. So when we talk about rules, really the tax rules apply to those two. And the last one we don't talk about, which is regulation. Sometimes there's city taxes, sometimes there's state taxes that are working outside of the income tax threshold. Talking about occupancy taxes, sales taxes. We also deal with those. We're not dealing with those today. We're talking about income tax changes, but these are really the three buckets that we work within. And it's a good way for you to talk to your accountant about which one am I trying to figure out? Am I trying to figure out a tax return that was already filed? Did I need to report? Am I trying to figure out how to get back to net income? Do I have an accounting question? Or did I get a letter from the city saying that I need to remit occupancy taxes, in which case we need to go a different avenue? So good backdrop. And that brings us to, I think, maybe the most important tax change that might or might not go into effect. I'm going to stop there and hand it over to my colleague, Daniela. She'll talk a little bit about how we're looking at bonus and thinking about bonus this year.
Yes, so bonus depreciation used to be 100% deductible. And now with the tax changes, it's been reducing every year. So as you can see, in 2023, it went to 80%. And then 2024, which is the tax filings, 2024, which is the tax returns we're working on right now, we're only at 60%. In 2025, we're only at 40%, which kind of makes the concept of buying assets that only qualify for bonus depreciation less attractive. However, this can change. We're keeping up to date with changes in Congress, and it's possible that it will get restored. But as of now, it's only 40%. So if we want to move on to the next slide. So examples of bonus depreciation. Where'd you go? So this basically shows how if you bought, let's say a vehicle. So some vehicles qualify for something called Section 179, which means you can actually take the full 100%, but it has to be like a heavy vehicle over, I think it's 5,000 pounds. So if you just buy a regular vehicle, it only qualifies for bonus. So you could see over here, the benefit of that, If you bought a $35,000 car, the bonus depreciation would have been, in 2022, you would have been able to deduct the whole thing. So you can see like tax savings associated with that would be approximately $12,000. So if we fast forward to 2025, since you can only take 40%, buying a $35,000 car, you can only deduct $14,000 of it, and your tax savings go down to almost $5,000. So essentially, your tax savings being like, if you have a good year and you want to buy a car, for example, you'd have to buy a very heavy SUV to qualify for 100% deduction, and that's not necessarily a good fit for everybody. So this rule really does impact people. And we're kind of keeping up, and we'll see if it gets restored. But as of now, the 40% deduction isn't as valuable as it used to.
Yeah, definitely. And I think like the practical effect is, I think, people looking in 2025 at buying anything that qualifies for bonus, you might just wait. You might just wait to see if tax, that doesn't mean wait to file. I think that just means that if you're looking at buying something in 2025, you might just wait to see if Congress says we're going to bring it back. Will they bring it back with this tiered schedule? I think maybe. The reason they did this is for budgetary reasons. So, they might say, hey, we're going to balance the budget. They said they're going to balance the budget in 2026. That was the logic of tearing down Tax Cuts and Jobs Act. So instead of just giving bonus depreciation forever, we're going to give 100% for 2025, 80% for 2026. So we'll adjust as that comes out. But thank you, Danielle. I think that's a pretty good punchline. Yeah, I just brought up some kind of just basics that always come up. Tax rates, 37% is still the highest. If you look at the difference for the highest tax bracket between married filing jointly and single, I was talking about this the other day. It was just like, is there even a tax benefit to being married? And actually, I say that somewhat jokingly, but on a serious note, there's been some actual tax projections that not being married actually favors you, because if you think about that marginal difference, 130,000 at the top rate from going from 35% to 37%, making 500,000 and then having a spouse, another high earner, makes 200. Like you might be pushing at the top where everything above gets taxed at 37%. And you would think that what Congress does is they incentivize certain, let's call it social or kind of outside of tax kind of behaviors that they think is good. So you would think, as in other, industrialized Western economies, that the tax rate would drop significantly for being married. But that difference, that delta for someone in that 600,000, if you're looking at selling stock, if you're looking at a big year, we also talk about how taxes is almost like a sine curve, right? It's like some years you do need actual tax planning. Other years, maybe you just sold your business and you're taking a year off. It's not a significant year to actually do anything with taxes. But on those high years, where there is a big difference, like someone that sells their business and then has a spouse making 200 or even 100, is just going to get whacked. And it used to be that QBI looked really good. QBI, which is the pass-through benefit, was like the differential between being married and not was really good. But now again, I think with inflation and just as the rules progress, the delta is just getting really small. So don't quote me on any kind of social conclusions here. I'm just simply stating that if you look at the code as written and the tax tables, there really isn't a benefit married filing jointly to single that to me tells me there's like good policy in place. I guess I'll say it that way. On the flip side, in terms of having something actionable, you should be looking at married filing jointly versus married filing single. And if you are having a big year and you're engaged and that wedding isn't fully planned, you might want to push that out to 2026. These are all things that, again, I kind of struggle because I'm saying blanket statements. 100% is going to be, it's going to have to come down on an individual basis what I'm saying. So these are the kinds of conversations that are really good to have when you're making big life changes, and a big reason that we put this out in the content we produce. And then I always have fun with the mileage deduction because I think it's the only thing that moves really close with inflation. So we're up to 70 cents, guys, which in some ways good. But if you look at any other phase out, like the inflation adjustment is 3 to 4%, where we've had 5 to 8% inflation. So good to know that there's one single thing in the annual updates that moves close to inflation. So what's going to happen? Well, first, let me start with what I think is good. And this is purely from a tax perspective. This is apolitical. But taxes were standing to get really high the last time we talked about tax change. So during the Biden administration, they were talking about bringing the highest rate up to almost 40%. Again, not talking about whether it's right or wrong, but they were talking about bringing up the top bracket. We're not talking about that now. There was talk about taxing unrealized gains, capital gains, meaning if you held an asset that appreciated, you may have to pay taxes on that. So we understand that is completely off the table now, which I think if you're just looking at projected tax and kind of the amount that you are going to have to budget for how much goes back to the government, it's good to see that go down. On the flip side, let's talk about what might happen. What I will say that we're sure of now is tax reform will happen. We do have the current president who said that there will be some tax reform within the first 100 days. I think that's very interesting, and it puts us tax professionals in a tough position because when you say something like that, that means it's going to happen during tax season. And because there's been tax changes since 2020, anyone in the tax business since 2020 has seen, I think, more change than any tax professional in a period before that, dating up to 1985. What I mean is that all my professional career, we were talking about when the rules changed in 1985, and rules changed in 1985. There were minor changes that happened in the early 2000s, but nothing like the Tax Cuts and Jobs Act to the COVID Relief Acts to PPP, things that really impact things in the current year. So what the world we live in now is that we know Congress and the president, for whatever reason, whether it's populism, whether it's buying votes, whether it's getting the economy to get really good, whatever you think, what we see is that we have a Congress and president that will make retroactive changes. And that's why there's a lot of uncertainty in the space because, for example, what if rules come out saying that now bonus depreciation is going to be 100% in 2024? For those of us that work in the tech space, TaxHack focuses on R&D tax credits. We've been talking about Section 174, which means that tech companies, instead of deducting, if they make $100 and they spend $100 in dev, on a cash basis, they're at zero. It used to be the tax rule said they didn't get taxed. Well, because Tax Cuts and Jobs Act expired, they are now only able to take 10% of that 100. So they now have a $90 profit, and they had to pay taxes on that. And that really it's really hurt the tech space. And there's a lot of people saying that those are the reasons, at least in part, for a lot of the tech layoffs and a lot of the lack of investment in the tech side. It could be AI, but there are thinkers out there that are saying it's actually tax reform. So could it be that we now get expense treatment on 2024? Of course, that's making taxpayers think about, well, why would I file? Maybe you just prep it, maybe extend it, wait and see. I think, and this is just Miguel's opinion, I will say it's not the firm opinion, is that the rules will be 2025 going forward. So the rules are going to be future-based, meaning in the current year, so that businesses can make different investment decisions in this current year instead of maybe changing the rules so that you get a refund in the prior year. That's just my opinion. I also think that in terms of what we do as a firm is we do file based on the numbers we have. Ultimately you can prepare it based on it, make a payment based on it, and extend so that if there is a change, you're changing a draft. But my official recommendation is to file based on the numbers. Well, I think Danielle, we hit the half-hour mark, so Danielle is now going to leave us. Thank you, Daniela, for your time with us. It's been an absolute pleasure and giving me a quick break.
Thank you, Miguel. All right. Thank you, everyone. And yeah, continue.
Well, great. Thank you, Daniela. So the good potentially. So I think the reason we say potentially is you know, it depends on what you're doing in your business and whether you'll benefit. So a lot of the rules incentivize actions or disincentivize actions. It doesn't blanket. It's not a blanket, reduction in tax rates, which we did see in 1985, and we saw during the Bush administration. I don't know, Tax Cuts and Jobs Act as well, with some caveats. I don't know that that's what Congress is discussing now. It does seem like it's really focused on bringing back the expiring provisions of the Tax Cuts and Jobs Act. A lot of, again, the way they wrote those rules is that they would say the future is going to pay for the benefit of now. I expect, again, this is all opinion, that what we're seeing in terms of the tariff policy, again, not speaking to whether it's good or bad, but what we're seeing is essentially a plan to raise taxes from alternative sources that allow for a more permanent, for a longer based tax cut. So we're not borrowing from tomorrow to pay for today. We're essentially charging other economies who do business with us in order to have a better tax policy for those that pay taxes here. We're also seeing a focus on benefiting actual taxpayers. We contrast that from maybe when we talk about the earned income tax credit or the child dependent tax credit, which Democrats historically have been very, very in favor of. Those are policies that help people that don't pay a significant portion, that don't pay an absolute dollar value of high taxes relative to the wealthy, versus policies that favor, you can say favor the rich, you can also say favor those that pay a significant portion of taxes, where we're starting to see, hey, we want to, I think the philosophy is we want to help investors and entrepreneurs be incentivized to continue investing, whether that's hiring, whether that's, again, I'm not drawing a political divide, I'm just saying historically, we've seen a focus on negotiating tax policies, some for the Dems, some for the GOP. I think the tax policies we're talking now are very focused on the entrepreneur, and very focused on those that pay taxes. So even if you've read about getting back a check, the Doge dividend, those would be reserved, at least in conversations. Again, this needs to go through Congress to really come out as part of a budget or as part of tax reform. So will it happen? I don't know. But what it tells us is that there is a focus on maybe giving back, maybe reducing, however you want to word it, taxes for those that are paying into the system. So if you write a big check to the government, some of us are in that boat. Those are the types of policies that we're expecting to see come out with tax reform. Okay, now there's this middle ground on what's going to happen with SALT, and I've heard some advisors say they think they're going to go away. Some people say it's going to double. Ultimately, we don't know, because I'll tell you why we don't know. Because I think net, if we go back to 1986 with Reagan, what that administration did is they essentially proposed a whole new tax regime that said it was going to be tax revenue neutral. So they were reducing taxes in one area, reducing incentives in another area, and then increasing them in a complete other area. And the argument was that net, this was going to increase investment, and revenue-wise, it would stay the same. We don't know what the thinking is right there, but essentially, you might be looking at something similar where we get rid of the SALT cap. So you essentially are allowing your property taxes, your income taxes to be deducted on your Schedule A. So it reduces your taxable income. That would be getting us closer to the pre-Tax Cuts and Jobs Act rules. Or alternatively, we might see rates across the board drop. And the way to pay for that, the way to balance that, is to completely remove the SALT tax cap. That's really important, because something that the tax space has evolved in order to get around that is that if you have a pass-through entity, we talk about PTE, so you pay your state taxes through your entity, and that passes through to you to give you a federal tax benefit. So you want to call that a loophole, you want to call it a strategy, whatever you want to call it, that exists because of the SALT cap. So there is a way to at least reduce the impact of the SALT cap right now. We will need to wait to see what happens, because that might change entirely. Other things might be good, might be bad. Eliminating mortgage interest. We're seeing that. So if you have an expensive mortgage with very high interest rates, what's happening today, that might hurt. That might hurt investment. Again, that's kind of above my pay grade. The point is we want to be very mindful about it, as well as specific benefits. I saw a question in the chat about what about electric cars. The rules right now is hey, there's a tax incentive. Will that go away? We don't know. I don't know. I can tell you I did a test drive at Rivian 2 weeks ago, and they're not political at all, but they're a business. They are touting that as one of the benefits of leasing a Rivian today. So rules of the land, again, it's going to be interesting to see the picking and choosing of winners and losers if you hold it like that. I think the point that we're making today is that tax planning needs to be evolutionary. So what I mean by that is we need to keep really tight with our clients. And if you're a Centurion Plan client, we either have a cadence where we meet with you in the middle of the year or quarterly, middle of the year, end of the year. These are the things that we're looking at before we even get on the call. So we're trying to evaluate where are the opportunities, where are the risks, because ultimately, if you are looking at, if let's say the rules come out that there's going to be no mortgage interest deduction, you might think twice about an 8% mortgage interest. Not to say that there isn't a core business or a core personal reason to upgrade your house, but on the margins, you would expect that it impacts you. So again, not here to fearmonger. I'm just sharing the things that have been discussed that we see coming out of publications like PwC, out of Thomson Reuters, and of course, in your congressional releases on what's being discovered or discussed rather. And some of this stuff is not me just making it up. I mean, some of this stuff is actually in proposed legislation. So there's a proposed bill that's essentially dead. It passed the Senate. Will it pass the House? Now that the House has changed, could they bring back that bill? What we're seeing is they're essentially waiting for some comprehensive tax reform that, according to what the president has said, it will be within the first 100 days. We've seen that this president, when he makes bold claims like that, he tends to make a big deal about it. So, will we see this within tax season? We've got 30 days left to see if that's true. We're going to wait and see. But we thought it'd be important to at least talk about some of the variables at play, because it is going to impact investment decisions. And I think what we're seeing across the space is a lot of investors and entrepreneurs are saying, let's wait 30 days before we make any big moves. And that's just the reality of the world we live in. We talk about the IRS Dirty Dozen every year. This is essentially the list the IRS comes out and says, essentially, these are the abusive tax strategies or abusive non-compliance things that we're seeing that we are going to invest resources in. So a quick note about that, because we've had some clients say that they've heard the president is going to abolish the IRS, is going to cut investment spending, and therefore, the thinking goes that there will be zero audits. It'll be the Wild West, and I don't need to file my tax return. I'm telling you personally, that's absolutely not going to happen, and I am going out on a limb saying that. So if you play this back in 6 months and the IRS is in fact gone, I will need to own that. But the reality is that the filing system is relied upon by the financial system. So if you get a loan, this, your transcripts are checked, and it impacts your credit bureau. It impacts and backs the entire economy. So some level of filing is never going to go away. In addition, there is not a constitutional lawyer, but there are rules in place that are going to preserve tax filing. The question is, how many people work at the IRS? I think that's very different than, do you need to file your tax return? You absolutely do. It impacts the entire kind of financial health of your profile for various reasons. We know it because we work with a lot of investors, we work with financial institutions, we work with capital partners. Your tax return is along with your financials, and there can be a gap between them. If you know what I'm saying, you might laugh, but the reality is that is the core verification of identity and financial credibility, or a main pillar, if not the core. So, will the IRS still audit? We absolutely think so. I don't think that the IRS needs to go, I think, the other way to less audits. I think, not just saying this as a professional, but I think, it does make sense for the IRS to be lean and smart. But it does make sense for the IRS to have a function where they are catching the really bad offenders. I don't want any of our clients to get audited, but just to be very clear, there does need to be some level of validation and verification at the IRS, just speaking functionally. So the IRS Dirty Dozen tells us essentially if the IRS department went to 10% of capacity, these are the things that they would still look at. So don't do these things, or think twice, think really hard about them before you look at them. And the one we usually talk about the most is the conservation easement. I think we had a few audits that we defended. You can see that on the list. And essentially that is a land grant that gets overvalued and you get a big donation as a result. So if that is still being sold to you, definitely reach out to me. I want to know who that fund is. It's essentially been something the IRS said, we're going to audit as many of these as possible. And we do, in fact, have clients that have been audited, and we're working through the reversals in payment plans, because essentially, if they said they made $200,000, they took a deduction for 25% of that income, so they made $175,000. They got a refund if they paid on the full $200,000 for that $25,000. And now the IRS is saying, hey, that was 5 years ago. We're assessing interest and penalties for 5 years. Interest rates have gone up. That's not a very pretty picture. So it's definitely something to get a strategic plan. And there's different ways you can do that, even reaching out to the IRS proactively in an anonymous way, which is something that we do in very rare situations. You'll see non-filing is probably the most obvious one. We deal with entrepreneurs that have been busy and grinding for 3, 4, 5 years and have not filed their tax returns. That's okay. My recommendation 100% of the time is to get caught up as soon as possible and start with the earliest last year and file an extension so that by October you can get all those tax returns filed. We don't let our clients go a year without filing, even if it's outside the statute of limitations, because the rules essentially say there's no statute of limitations if you don't file. And for the reason I shared earlier, if you do not report on income, the IRS does say, we're not going to give you deductions. We're just going to tax you on your revenue. We're going to take 35, 37% of whatever that amount is. And that's what your tax bill is. And again, going back 3, 4, 5 years, we're going to assess interest and penalties at higher interest rates. It is not a pretty picture. The interest is not forgivable. Like, I'll say that again. I can get a lot of clients who are like, hey, can I get some break on the interest? Unless the underlying position of the IRS is incorrect, you're not going to get a break on interest, and even penalties are negotiable. So oftentimes, getting a payment plan, making you a viable taxpayer and loanee for banks is a good thing. So we definitely want to get out of the non-payment. Cryptocurrency is probably one that we will see in the next 3 to 4 years become a more sophisticated filing requirement. Right now, it's very unsophisticated, and what I think Treasuries try to do is they just try to create a box on the tax return that says, did you earn crypto? Did you buy it? Did you sell it? And if you check no on that, you've now committed tax fraud. So what they're trying to do is they're essentially trying to just create a pile of taxpayers that they can maybe observe in future years. So we do encourage our clients to do strategic compliance with crypto. And the way we do that is we have a tool that we connect clients to. It essentially connects with all your wallets. It tracks the value of it. So I get an email probably too often on what my total holdings are. You only report if you earn in crypto, if you sell crypto, or if you mine crypto. So we want to be, I think, very strategic about how that's presented. And of course, we know that there are different ways to value crypto. Some wallets have gone completely away. Some exchanges have gone completely away. So there's data, missing. We want to proactively say, hey, this is what the data is. Because again, if you don't, back to the example of not reporting your income, if you don't do that, the IRS has the right and maybe the strategy to say, hey, we're going to find the highest value of that crypto in the year that we think you bought it, and we see that you sold it for $1, and maybe you took a bath on it, but they're going to say, you know what, we're going to say that you bought it at a penny, so we're going to tax you essentially 99 cents on all your shares where you could have bought in at a much higher amount and actually have a loss. So that's essentially what we want to look at when it comes to those. So the IRS Dirty Dozen comes out every year. You can look it up. Essentially, if the IRS goes to 10 people, you're going to have one person on a different Dirty Dozen case across the board. So those are essentially what to look forward to, not to do. And if you have something or a concern here, we're certainly here receptive. We believe in strategic reporting and strategic compliance, meaning that we're not going to break the rules, but we're not going to put you out in front of the tax reporting agencies and say, hey, look at all my stuff. We're going to be very strategic about how we do that in order to do the right thing in the right way. I used to go into what a conservation easement is. I think it's becoming less important. BOI, this is the last thing that we're going to cover here. And then I want to field some questions from the audience. I heard from the chat that the audio is not playing. So typically here we would have Carla share her thoughts on it. But essentially, BOI, we've beat this thing up. The Congress, bipartisan Congress, passed the rule that essentially they want to know who the owners are behind every entity with very minor exceptions. So essentially the exceptions are, the exceptions I will say are if you're very public, if you're a sole proprietor, which is not an actual entity. So the exceptions are very few and far between. And what we've had a debate over as an industry, but also with our clients, is, hey, do we wait till we find out if it's really required? We know there's some challenges in the Supreme Court. I think up until last week, we almost delayed this presentation. Up until last week, the website says that filing is voluntary. So you don't even need to file. We've got a update now from FinCEN on the website. They say the updated deadline is March 21st. So you do need to file. This is something where we are chasing what I think we're trying to identify the lowest risk way of complying. And I think the reality is that because the penalties are so strict, that let's say that the case before the Supreme Court decides ultimately that you need to file BOI, you're going to be exposed. So we don't think it's worth it. We think it makes more sense, even if you do it yourself. If you can't be bothered and you get on there and you go, this is too much, or this is too annoying, or this triggers me, this makes me anxious, we're happy to help. And we have a competitive price. I mean, we're a service, so you have a human being actually doing these for you. There are other tools out there. I don't think this is how we make tons of money as a firm. We just don't want our clients to fall outside of compliance. So if you do need support on this, we are saying, hey, you've got about a month to actually file this thing. We're just going to parrot what the rules are. If you want to be out of compliance, that's on you. And we will not support. We'll be very clear. We are not going to support any of the back and forth. So essentially, if you tell us you're not going to comply, we are not going to support you with any of the controversy that happens as a result. We do think that in the future there is some marrying of BOI. It is the Treasury Department on the tax return. So could there be a world where when you file a Schedule C and you put the LLC name, that there's a box that says, did you file your BOI report, or paste your BOI confirmation number? We certainly think that is a reasonable future update in the system. So again, we don't want you to do anything that is overexposing you, but certainly in this case, because of the penalties, because they're daily penalties, there's criminal penalties. These are really designed for those that refuse to comply because they are criminals. The cost is just too great, and we just don't know what. Let's say the case is lost at the Supreme Court, meaning that this is the law of the land. We were right. We don't know if there's any forgiveness for people that didn't file. Okay. The other reality is that even if the Supreme Court says you don't need to file, because this was such a joint effort from Congress, again, this was bipartisan. Congress can update the rules or clarify whatever the Supreme Court says is non-constitutional to make it the law of the land. So look, it takes 30 minutes. We'll do it for you. We just think this is something that our clients should check off their list. Okay, so conclusions. I'm going to ignore all this, and I'm just going to say that the main point of today is that taxes right now are very fluid for what's going to happen in the future. What we're certain of right now is that 2024 rules are the law of the land. The tax forms have been put out by Treasury to reflect those rules. So I would, not a betting man, but I have a strong sense of certainty that rules will be made going forward. So even if you disagree with me, my recommendation is still to get as close as you can to filing. And if you do want to wait to see what policy changes, to have that return ready to hit the file button, have the taxes paid on what that tax on what that tax return says. Again, these are taxes for last year. And then if you're going to wait, give some time to see what happens in 2025. It's very likely that there are going to be new rules announced during tax season, and just the reality of our business is that we are not going to be able to do strategic planning during tax season before that April 11th filing deadline that we have. So recommendation is to make sure that you've got something scheduled after tax season to discuss tax planning, what will change, what might change in the future. So that is really it. I mean, I think taxes are getting harder, and you might think that we like it in the tax space, like the harder it is, the higher fees go. That's absolutely not the case. I mean, I think where we really see our value is in looking forward based on agreed upon rules. Very hard to do when there aren't agreed upon rules. So that remains, I think, the biggest challenge, mutual challenge. And we want to make sure that we're advocating for our clients and getting them the best deal they can possibly get. That's good for our business. It's good for your business. It allows you to reinvest in the future. It allows us to work as partners. So we want to make sure that we're hitting this year hard. If you have not worked with a tax planner before, we highly recommend you reach out. Again, that last bucket is where we want to spend our time. So we do want to make sure that we've got a plan first on your filing, that you have a good system for accounting, whether that's an internal system or whether that's an outsourced bookkeeper. We've rolled out a accounting operation strategy with Daniela joining, so we're happy to engage there. And ultimately, what we want to do is get to the point where we're looking forward. We're helping you manage that tax bill. We're aware of the investments you're making, and we're working with a broader network of your advisors, whether that's insurance folks, whether that's your financial planner, or your attorney. That's really where we see ourselves really growing with the business community. And even if you're small and you're just getting started and you're just like, hey, I just need to learn how to do my own accounting, we have resources for that if you are in that place in your journey. And if you're getting to a place where you feel that it's no longer worth your time to tick and tie to figure all this stuff out, we think that we have a very good team for the small business owner where it's not going to cost an arm and a leg for good, consistent reporting. And we provide that on a semi-annual basis. So we get a plan where you get it twice a year. If cost is a factor, if this year you're planning on selling the business in the next year, you might want to get it on a monthly basis. But again, we are dedicated to the small, growing entrepreneur and investor, whether that's a smaller tech business or whether it's a smaller real estate portfolio. And we're really excited about being that partner this year, especially with all that uncertainty. So we hear you if you're frustrated. Also, we've got a chat here. I'm trying to check it here and there. I'm going to give it more attention. So if you have questions, feel free to put those in. And with that, I'm going to take just a little water break because that was a marathon. Okay, I think we got a question on the vehicle bonus. Carla got that. It is 6,000 pounds. Got a question on fees. Let's see. I think the best way to reach out to us is on our contact form. We have a human being that's dedicated to get back to you. So questions on fees or how we would serve you should go there. This is our holding company website. You can visit us at, I think I would recommend going to the respective brand. So if you go to sharedeconomycpa.com, there's a contact form there. Best way to get a hold of us. How long has BOI been in effect? BOI went into effect on January 1st. It has been talked about since, I think since December 23 or early 2024. So we've been talking about it all year. We're extremely exhausted about it. And it has, I think, created a divide in our client base of those that, feel like it's really intrusive. I don't want to hand anything over. Look, they want to verify that a human being owns the LLC. So, if you do watch a lot of the LLC investment tax TikTok stuff about having a shadow entity, nobody knows you can, who owns the real estate, like that's going away. And I think, net, I mean, it's not a bad thing. Would we like to secretly own the condo on the corner? Maybe. But at the same time, I mean, think about all the private equity firms that are buying up houses in our neighborhood. Does disclosure, I think, kind of reveal some of that to allow us as a community to maybe challenge that? I think so. So I think net, I personally think that this is a level of transparency that is not egregious. Again, I'm like in my head, I'm like arguing with the client who's like, I don't want anyone to know anything. That's what insurance is for. I think as we become an economy of asset holders, I think this is just kind of par for the course. This is the level of transparency that is the cost for operating in what today I still hope is the fastest growing economy of opportunity in the world. Well, I'll give it another minute, see if anyone else has a question for the group. I got it, thank you. So that tells me it's lunchtime. All right, everyone. Well, thank you so much for your time. This has been, I always appreciate folks carving out part of their day to listen about tax. Definitely reach out if you have any questions. I'd be more than happy to engage with questions that come after as well. Thanks, everybody.